All right, people are starting to log in. So got a few more to go though. Somebody's connecting. Josh. Okay, time for the meeting to begin. So Saturday, I completed the third quiz and posted it on Canvas. And I didn't have time this morning to check to see if anybody had taken it. I didn't get any email questions about the study guide, which means either it was self-explanatory or nobody looked at it. So Christy sent me an email asking about how to study for the Peregrine comprehensive test. And so later this afternoon or evening, I will put that together and make an announcement on Canvas with instructions. Since it comes from all of your different accounting classes and I don't teach them all, some of the guidance I give will be pretty vague and general for some cases. Others, it will be a little bit more specific. Okay, does anybody have questions or comments before we get started on the lecture? Okay, then let's go to share the screen. And this is the last slide where we left off in class on Friday. So I mentioned the different models of how they used to set accounting standards, but we didn't go through them. Starting with the Anglo-Dutch model, this is how accounting standards were set in the USA, the United Kingdom, Canada, Australia, New Zealand, and the Netherlands. All of them English-speaking countries except the Netherlands, with strong professional accounting organizations, strong market-based economies, government-regulated financial markets, laws that are based on both legal codes and on common law, and tax codes that differed from GAAP. I would point out that in the Netherlands, for several hundred years, the Netherlands and the United Kingdom have had a lot of trade between each other, and there are a lot of companies that are binational, owned by shareholders, some in the UK, some in the Netherlands. And in the Netherlands, people speak English so well in addition to their Dutch that when I was there in Amsterdam, walking down the street, most of the Dutch that I passed by were speaking to each other in English, not even in their own language of Dutch. And when I looked into a Dutch bookstore, most of the books in there were in English, which I thought it was kind of a surprise to me. At any rate, so they had private sector standard setting bodies, and each of them had a strong professional accounting organization like the AICPA in the United States, In Canada, the United Kingdom, they called them chartered accountants. And they had a lot of influence over auditing and setting the accounting standards. Second model, continental Europe and Japan. In these countries, the financial markets had smaller roles than in the Dutch and Anglo countries. Most investment capital here was arranged through banks, not through bonds or stocks. There was more influence from prominent wealthy families. Companies were more closely intertwined with each other. There is more emphasis on tax accounting and filling out government forms. The laws in these countries are based on legal codes, not on common law. And so the accounting standards in those countries would end up being like a tax return where you fill in the blank. Latin American accounting. There were differences from country to country, sometimes major differences, sometimes minor ones. And since their economies were in the shadow of their big neighbor to the north, many companies had supplements to their financial statements that reconciled the results of local GAAP to USA GAAP. Third world accounting. The poor countries did not have well-developed market economies or financial markets. Some people argued about whether that was the chicken or the egg. Were they poor because they didn't have market economies, or did they not have market economies because they were poor? Capital was hard to obtain and was often in the hands of a small ruling class. Frequently, the rulers have personal interests in important sectors of the economy and are sometimes kleptocrats, rulers who loot the country for their own personal benefit. And there isn't much need for accounting standards in a kleptocracy. And let me back up a little bit. What does the crat in democracy, the CRA, mean? It means rule. Anarchy, that means no government. What's a kleptomaniac? It's someone who has an irresistible urge to steal, right? So in Greek, klepto meant stealing. So these kleptocrat literally means government by thieves. Without working capital markets, economic growth was hindered. Hyperinflation can be a problem in poor countries when the government spends more than it can afford. Something to look forward to here, perhaps. The spending is financed by debasing the currency. Note that kleptocracy keeps a country poor. The law of Moses said that if Israel were to appoint a king, the king must not build up a large stable of horses for himself or send his people to Egypt to buy horses. For the Lord has told you, you must never return to Egypt. The king must not take many wives for himself because they will turn his heart away from the Lord, and he must not accumulate large amounts of wealth in silver and gold for himself. When he sits on the throne as king, he must copy for himself this body of instruction on a scroll in the presence of the Levitical priests. He must always keep that copy with him and read it daily as long as he lives. That way he will learn to fear the Lord his God by obeying all the terms of these instructions and decrees. This regular reading will prevent him from becoming proud and acting as if he is above his fellow citizens. It will also prevent him from turning away from these commands in the smallest way, and it will ensure that he and his descendants will reign for many generations in Israel. They didn't do that, but if they had, their history might have been happier. So if you have a kleptocracy, you have a ruler who's confiscating wealth from the citizens of the country. And when that happens, they no longer have an incentive to do any work because whatever they produce is going to be taken anyway. Changing economies. Countries that were moving out of poverty or socialism into market-based economies included the former communist countries of Eastern Europe, some Latin American countries such as Chile and Brazil, and the Asian countries of India, Thailand, Malaysia, etc. For these countries, the most natural and easiest course of action is to adopt international standards. Thailand had its own standard-setting body for a while. In fact, one of my classmates from my doctoral program was on their equivalent of FASB. But they ended up going to strictly following FASB standards. Socialist accounting. Socialist countries are countries in which the government owns or is attempting to own the majority of the economy. The state attempts through central planning using tax policy, regulation, spending, and budgetary policy to control the economy. The state budget and corporate accounting are therefore intertwined with each other. Some European countries have experimented with socialism. New Zealand tried it for a while. They all moved away from it, finding it didn't work. Other examples include Bolivia and Venezuela, which had dictators who attempted to seize control of their economies. Communist accounting is socialist accounting on steroids. In a communist country, there are no privately owned firms at all. The entire economy is centrally planned. So bureaucrats in the capital decide who's going to make what where. Communist countries include Cuba, Vietnam, North Korea, China, and Laos. However, although Vietnam and China have communist governments, they have been rapidly moving toward market-based economies. Because of the hindrance created by conflicting accounting standards to the free movement of capital in international markets, the concept of a single global set of standards became a popular goal. The international accounting, I forgot what the S stands for. Now the International Accounting Standards Board was established in 1973 to accomplish that goal. It now has members from over 100 different countries. Standards became mandatory in the European Union in 2005. They're gradually trying to harmonize their standards with the USA. For either the USA or the IASB issue a new standard, they consult with each other trying to make it either the same or as close together, similar as possible, but there have always been some issues where they can't agree. So it never may be completely reconciled. The SEC already allows corporations that are registered with it to use IFRS instead of USA GAAP. Biblical integration. When assessing changes in accounting standards, and this applies to the convergence of national standards to IFRS, as well as to our next discussion of the debate between principles-based and rules-based accounting, the question should be asked, is there a biblical basis for reassessing accounting standards? Phil Rickard claimed that biblical stewardship of a company demands monitoring, but old wineskins are not suitable for new wine. By this metaphor, he used biblical language to suggest that accounting standards may become obsolete. But biblically speaking, how do we judge accounting standards? I would suggest that we go back to the biblical principle of the golden rule. Do to others whatever you would like them to do to you. This is the essence of all that is taught in the law and the prophets. The standard for judging accounting standards should be, what would the organization's stakeholders want to know? So Questions or comments before we move on to the next topic? Okay, so there is an ongoing debate in accounting between principles-based and rules-based GAAP. There are two somewhat different approaches advocated for setting accounting standards. Let's start with rules-based GAAP. USA GAAP traditionally has been primarily rules-based, meaning that the accounting standards give detailed rules to follow. In this system, financial reporting can be seen as an act of compliance rather than as an act of communication. Rules-based GAAP is sometimes referred to as bright line accounting. A bright line rule is a clearly defined rule or standard composed of objective factors which leaves little or no room for varying interpretation. The purpose of a bright line rule is to produce predictable and consistent results in its application. The advantage of rules-based GAAP, many US companies like it and have pressured FASB for detailed rules because they want to be able to comply with cookbook accounting rules. That is, in a cookbook, you have recipes that if you follow it step by step, exactly following the instructions, you will end up successfully making whatever dish you're trying to cook. Rather than having to determine the proper disclosure that might be required when the guidelines are loose. The disadvantage, some companies will take advantage of specific detailed rules to find loopholes that technically follow the rule but actually provide a vehicle for circumventing the intention of the standard. It can be very difficult to write rules that would cover every possible circumstance. Principles-based GAAP is the other strategy. It begins with a conceptual basis, which is then used to develop key objectives. Broad guidelines to achieve those objectives are used instead of detailed rules. Although some rules are unavoidable, the guidelines or rules set are not meant to be used for every situation. The advantage of principles-based accounting, the fundamental advantage of principles-based accounting is that its broad guidelines can be practical for a variety of circumstances. Precise requirements, as in rules-based accounting, can sometimes compel managers to manipulate the statements to fit what is compulsory. And let me give you an illustration of something that I encounter. It's not accounting, but it might communicate the idea. You all know that we have adjunct instructors at Belhaven. You, I think, are all taking forensic accounting right now with David Prey, who's an adjunct. And so for accreditation purposes, we have to prove to the accrediting body that the adjuncts teaching our classes have the right qualifications, which in college academics we call their credentials. And so we have a software program that's initials are SPOL, S-P-O-L, strategic, I don't remember what the other letters are for. And in that program, we can upload the academic transcripts. We can have a place to put whether the instructor has a CPA license, master's degree, doctoral degree, whatever. There's a place for it. But in many of the things that are required by the programmer that you have to answer, for example, if I say that he has a certification like the CPA license, I can look that up on the website of the Mississippi Society of CPAs to find out if someone has an actual license or not. And it tells me the year they got the license. But SPOL requires me to give the day and the month that the license was acquired. And if I just put in the year, it won't accept the information. So I have to make up the day and the month in order, and without doing that, I can't even indicate that the person has credentials, or a license rather. So sometimes if you have bright line rules, it might force a company to give information that technically follows the rule, but is actually misleading because of the way it's set up. I don't know if that enlightens you or not. At any rate, the disadvantage of principles-based accounting. The problem with principles-based guidelines is that its lack of guidelines can produce unreliable and inconsistent information that makes it difficult to compare one organization to another. Further, it can be a challenge for auditors to definitely state that a financial statement is fair if the standards are not crystal clear. Which is best? Increased discussion has pushed accountants toward principle-based accounting. That's the consensus opinion of most people analyzing the issue, but it is recognized that the method needs to be modified to make it more effective. And that's obviously a typo, more effective and effective. I'll have to figure out what it was supposed to be. That's why a hybrid of the two has been suggested. And that hybrid is called objective-oriented standards. The SEC has suggested a modified principles-based system that it called objective-oriented standards. This system would avoid bright line standards and would explicitly charge management with the responsibility for capturing within the company's financial reports the economic substance of transactions and events. Auditors would be responsible for reporting whether management had fulfilled that responsibility. That may require less use of judgment, and it may better facilitate consistency and compliance with intent of the standards. Okay, so that finishes this PowerPoint. And we are, I think, in good shape. We've got one more unit to complete before the end of the semester. And since some of you still have to complete writing assignments and the third quiz, I think we could break off early this time and then meet again on Wednesday. So any questions or things you need to ask before we go? All right, then. Take care, follow the health guidelines that they're giving everybody, be very careful, and I'll see you again on Wednesday. Talk to you later. Bye.